An emergency fund is a crucial aspect of personal finance that serves as a safety net during unforeseen circumstances. It helps protect you from the financial stress that can accompany unexpected events, such as job loss, medical emergencies, or urgent car and home repairs. By having a readily accessible source of funds, you can cover these expenses without resorting to high-interest loans or incurring credit card debt. Furthermore, an emergency fund can provide a sense of financial security and peace of mind, knowing that you have a cushion to fall back on in times of need. It allows you to be better prepared for life's uncertainties, reducing anxiety and stress related to financial matters. In essence, an emergency fund is an essential component of a sound financial plan, enabling you to navigate challenging situations with greater confidence and resilience. Today, we will be discussing the process of building an emergency fund from scratch. Regardless of your current financial situation, taking steps to create a safety net for unforeseen expenses is essential for maintaining long-term financial stability. Throughout this guide, we will provide practical advice and actionable tips on establishing an emergency fund, even if you're starting with little or no savings. From setting a savings target and tracking your expenses to automating your savings and staying disciplined, we will cover every aspect of building a solid emergency fund that will serve as your financial safety net during life's unexpected challenges. By following these steps, you can take control of your finances, reduce stress, and secure a more financially stable future for yourself and your loved ones. Financial experts typically recommend having an emergency fund that covers at least 3 to 6 months' worth of living expenses. This amount is considered a reasonable safety net that can help you weather most unexpected financial emergencies without having to rely on debt or external support. The rationale behind this recommendation is that it provides a sufficient buffer to cover your essential expenses in case of job loss, medical emergencies, or other unforeseen situations. It allows you the necessary time to find a new job, recover from an illness, or address other financial setbacks without compromising your financial stability. It's important to note that the ideal size of your emergency fund may vary depending on factors such as your job security, family situation, and risk tolerance. For example, if you have a stable job with a low likelihood of unemployment, or you have additional sources of income, a 3-month buffer may be sufficient. On the other hand, if your job situation is more uncertain, or you have dependents relying on your income, aiming for a larger emergency fund of up to 6 months' worth of living expenses may be more appropriate. When determining the appropriate target for your emergency fund, it is crucial to consider various factors that may influence the amount you need to set aside. These factors can help you tailor your emergency fund to meet your specific needs and financial circumstances. Job security is one important aspect to think about. If you work in an industry with high job stability, a smaller emergency fund may suffice. Conversely, if your employment is less secure or subject to seasonal fluctuations, it is wise to aim for a larger emergency fund to cover potential periods of unemployment. Your family situation also plays a significant role in determining the size of your emergency fund. If you have dependents, such as children or elderly relatives who rely on your income, you should consider having a more substantial emergency fund to ensure their needs are met during financial emergencies. Additionally, if your partner or spouse also contributes to the household income, you may adjust your emergency fund size accordingly as you have an extra source of financial support. Other factors to take into account include your existing financial obligations, such as mortgage payments or student loans, and your personal risk tolerance. By carefully evaluating these factors and your unique financial situation, you can set a realistic and achievable target for your emergency fund, ensuring that you are well prepared to face unexpected financial challenges. Gaining a clear understanding of your spending habits is essential for managing your finances effectively and building a solid foundation for financial success. By closely examining your spending patterns, you can identify areas where you can save money, allocate resources more efficiently, and make better-informed decisions regarding your financial goals. Analyzing your spending habits enables you to differentiate between essential and non-essential expenses. Recognizing the distinction helps you prioritize your spending and allocate a larger portion of your income to necessities, such as housing, groceries, and utilities, while reducing discretionary expenses that might be draining your budget. Moreover, understanding your spending habits helps you make more informed choices about your financial future. By recognizing where your money is going and identifying any financial leaks, you can adjust your spending behavior to align with your long-term goals, such as saving for a down payment on a house, funding your child's education, or planning for retirement. Furthermore, being aware of your spending patterns can also help you develop healthier financial habits. By actively monitoring your expenses, you become more conscious of your financial decisions and can proactively make adjustments to curb impulsive or unnecessary spending. This awareness empowers you to take control of your finances, paving the way for improved financial stability and long-term success. In conclusion, understanding your spending habits is a vital step towards achieving financial security and reaching your financial goals. By monitoring your expenses and adjusting your spending behavior accordingly, you can create a more balanced and sustainable financial plan that serves as the foundation for a prosperous future. To achieve financial success, it's essential to track your expenses and identify areas where you can cut back or eliminate spending. By doing so, you can create a more efficient budget and allocate resources toward your financial goals. Here are some tips on how to effectively track expenses and pinpoint areas for improvement. First, establish a system for tracking your spending. There are several methods available, from traditional pen and paper to digital tools like budgeting apps and online banking services. Choose a method that works best for you and make a habit of recording your expenses consistently. Next, categorize your expenses to better understand where your money is going. Common categories include housing, utilities, groceries, transportation, and entertainment. By breaking down your spending into categories, you can quickly identify areas where you may be overspending and target those areas for cost reduction. Review your expenses regularly to stay on top of your financial situation. Analyze your spending patterns over time to detect trends or fluctuations. This practice will help you spot potential problem areas and make timely adjustments to your budget as needed. Once you've identified areas where you can cut back, consider implementing cost-saving strategies. For example, you might reduce dining out and cook more meals at home, utilize public transportation instead of driving, or cancel subscriptions you no longer use. The key is to be proactive and creative in finding ways to save money without sacrificing your quality of life. In conclusion, tracking your expenses and identifying areas to cut back or eliminate is a crucial step toward financial success. By staying vigilant and proactive about your spending habits, you can create a more efficient budget that allows you to allocate resources toward achieving your financial goals and securing a stable financial future. Automating savings is a powerful financial strategy that can help you effortlessly build your emergency fund, save for long-term goals, and maintain a healthy financial life. By setting up automatic transfers from your checking account to your savings account, you can ensure that a portion of your income is consistently allocated to your savings goals. Let's explore the benefits of automating savings. First and foremost, automating savings removes the need for manual transfers, saving you time and effort. By setting up a recurring transfer, you can set it and forget it, ensuring that your savings goals are met without the need for constant monitoring. Second, automating your savings helps eliminate the temptation to spend the money designated for savings. By transferring funds directly from your paycheck or checking account, you reduce the likelihood of impulsive spending as the money is moved before you have a chance to spend it. Additionally, automating savings encourages consistent saving habits. Regular contributions to your savings account, no matter how small, can add up over time, allowing you to steadily work toward your financial goals. This consistency can lead to a stronger sense of financial security and confidence in your ability to manage money. Another benefit of automating savings is the power of compound interest. When you consistently contribute to your savings account, your money can grow faster through interest earnings. Over time, the interest you earn will begin to generate its own interest, accelerating your savings growth and helping you reach your financial goals more quickly. Finally, automating savings can provide peace of mind. Knowing that you are consistently working toward your financial goals can alleviate stress and help you feel more in control of your financial future. In conclusion, automating savings is a smart financial strategy that offers numerous benefits, including time savings, reduced temptation to spend, consistent saving habits, the power of compound interest, and peace of mind. By incorporating this practice into your financial routine, you can build a strong foundation for a healthy financial life and work toward achieving your financial goals with ease. Establishing a dedicated savings account and scheduling regular transfers is an essential step in building an emergency fund or saving for other financial goals. This process ensures that your savings are kept separate from your everyday spending money and helps you stay on track with your financial objectives. Here's a simple guide to setting up a dedicated account and scheduling regular transfers. First, choose a financial institution that meets your needs. Look for a bank or credit union that offers competitive interest rates, low or no fees, and convenient access to your funds. You may want to consider an online bank or a high-yield savings account, as these often provide better interest rates than traditional banks. Once you've selected a financial institution, open a dedicated savings account. This account should be separate from your checking account and used exclusively for your savings goals. Having a separate account helps you avoid accidentally spending your savings and provides a clear picture of your progress toward your financial objectives. Next, determine the amount and frequency of your transfers. Take a close look at your budget and decide how much you can afford to save each month. This amount should be realistic and achievable, taking into account your income, expenses, and other financial commitments. Decide whether you want to transfer money weekly, bi-weekly, or monthly, depending on your pay schedule and personal preferences. Once you've determined your transfer amount and frequency, set up automatic transfers from your checking account to your dedicated savings account. Most banks and credit unions offer the option to schedule recurring transfers online or through their mobile app. Be sure to double-check the transfer details, including the amount, frequency, and start date, before confirming the setup. With your dedicated account and scheduled transfers in place, you can begin to watch your savings grow over time. Regularly review your progress and adjust your transfer amount as needed to stay on track with your financial goals. This efficient savings strategy will help you build an emergency fund, save for future expenses, and create a solid financial foundation for your future. Remember to monitor your savings account regularly, and don't hesitate to adjust your strategy if your financial situation changes. With dedication and consistency, you'll be well on your way to achieving your financial goals. Building an emergency fund is a crucial step in securing financial stability. However, it can be challenging to resist the temptation to dip into these savings for non-essential expenses. Here are some helpful tips for maintaining financial discipline and keeping your emergency fund intact. First, establish a clear purpose for your emergency fund. Understand that this money is meant to cover unexpected expenses or emergencies, such as job loss, medical bills, or urgent home repairs. Having a clear goal in mind helps reinforce the importance of leaving the fund untouched for non-essential expenses. To further discourage unnecessary spending, consider keeping your emergency fund in a separate dedicated savings account. This physical separation from your daily spending account makes it more difficult to access the funds and provides a psychological barrier against impulsive spending. Next, make a habit of regularly reviewing your financial goals and tracking your progress. By staying focused on your long-term objectives, you're less likely to be swayed by short-term desires. Celebrate your milestones and remind yourself of the reasons behind your savings efforts. Create a buffer for discretionary spending within your regular budget. Allocate a small portion of your income for non-essential expenses, like entertainment or dining out. This way, you can enjoy occasional indulgences without tapping into your emergency fund. Another useful strategy is to implement a waiting period for non-essential purchases. If you find yourself tempted to use your emergency fund for a non-essential expense, wait a few days or even a week before making a decision. This cooling-off period allows you to reconsider your priorities and determine if the purchase is truly necessary. Finally, develop healthy financial habits that support your long-term goals. Stick to a budget, avoid impulse purchases, and cultivate a frugal mindset. By consistently practicing these habits, you'll reinforce the importance of protecting your emergency fund and build a strong foundation for financial success. By following these tips and maintaining financial discipline, you can avoid the temptation to dip into your emergency fund for non-essential expenses, ensuring that you're prepared for life's unexpected challenges. Financial discipline is the cornerstone of long-term financial success and stability. It is the practice of managing your money in a consistent and responsible manner, allowing you to achieve your financial goals and navigate economic uncertainties. Let's delve into the importance of maintaining financial discipline in various aspects of your financial life. First and foremost, financial discipline helps you build a solid foundation for your financial future. By consistently sticking to a budget, saving, and investing wisely, you can create a stable financial base that allows you to weather economic storms, meet unforeseen expenses, and even enjoy a comfortable retirement. Financial discipline is also essential in achieving your financial goals. Whether you're saving for a down payment on a home, funding your children's education, or planning a dream vacation, disciplined spending and saving habits enable you to accumulate the necessary resources to fulfill your aspirations. In addition, practicing financial discipline helps you avoid excessive debt. By living within your means and carefully managing credit, you can prevent the accumulation of unmanageable debt that can lead to financial stress and long-term consequences for your financial well-being. Moreover, maintaining financial discipline allows you to build a strong credit history. By paying bills on time, managing debt responsibly, and avoiding unnecessary credit inquiries, you demonstrate to lenders that you are a reliable borrower. A strong credit history can result in better interest rates, more favorable loan terms, and increased access to financial opportunities. Furthermore, financial discipline contributes to your overall sense of financial security and peace of mind. Knowing that you have control over your finances and are working towards your financial goals can reduce stress, enhance your overall well-being, and even positively impact your relationships and career. Lastly, practicing financial discipline helps you develop the resilience to adapt to changing economic conditions. By cultivating good money management habits, you're better equipped to navigate financial challenges such as job loss, market fluctuations, or unexpected expenses without jeopardizing your long-term financial health. In summary, maintaining financial discipline is vital for achieving financial success, stability, and security. By consistently practicing responsible money management habits, you can build a strong financial foundation, reach your goals, and enjoy a more prosperous and fulfilling life. Monitoring your progress towards your emergency fund goal is essential for ensuring that you're staying on track and making consistent progress. By regularly reviewing your savings growth, you can identify any obstacles or setbacks and make necessary adjustments to reach your target. Here's how to effectively track your progress towards building your emergency fund. First, establish clear, measurable goals for your emergency fund. Determine how much you need to save, taking into account your living expenses, job security, and other financial factors. Make sure your target is realistic and achievable within your desired time frame. Next, set up a dedicated savings account specifically for your emergency fund. This account should be separate from your regular checking or savings accounts to avoid mixing funds and make it easier to track your progress. Make sure to schedule regular transfers or deposits into your emergency fund account. You can do this by automating a portion of your paycheck or setting up recurring transfers from your main checking account. Consistent contributions are crucial for steady progress towards your goal. Utilize budgeting and tracking tools to monitor your savings growth. Many financial institutions offer online and mobile banking features that allow you to view your account balances and transaction history. Additionally, there are numerous budgeting apps and software programs that can help you track your savings and visualize your progress. Regularly review your progress and make adjustments as needed. Check your emergency fund balance at least once a month to ensure that you're staying on track. If you find that you're falling behind or encountering challenges, consider revising your savings strategy, cutting back on non-essential expenses, or finding additional income sources. Celebrate milestones and achievements along the way. Recognizing your progress can boost your motivation and keep you focused on your ultimate goal. Whether you've reached 25%, 50%, or 75% of your target, take a moment to appreciate your hard work and commitment to building financial security. In conclusion, tracking your progress towards your emergency fund goal is crucial for staying on track and achieving your desired financial cushion. By setting clear goals, consistently contributing to your savings, and regularly reviewing your progress, you can build a solid emergency fund that will provide peace of mind and financial stability when unexpected expenses arise. Life is unpredictable, and sometimes you may need to adjust your savings plan to account for changes in your financial situation or goals. Here are some tips on how to modify your savings strategy when necessary, ensuring that you continue to make progress toward your emergency fund or other financial objectives. First, reassess your financial goals and priorities. If your financial situation has changed, it's important to reevaluate your goals to ensure they still align with your current circumstances. Determine whether your target amount, time frame, or overall objectives need to be adjusted. Next, analyze your current budget and spending habits. Review your income, expenses, and savings contributions to identify any areas where you can make adjustments. Look for opportunities to cut back on non-essential spending or increase your income through side gigs or freelance work. Consider reallocating funds from other savings goals or accounts. If building your emergency fund has become a higher priority, you may want to temporarily redirect funds from other savings goals, such as vacations or large purchases, to focus on achieving your emergency fund target. Adjust your savings plan gradually, if possible. Making small, incremental changes to your budget and savings strategy can be more manageable and sustainable in the long run. Try increasing your savings contributions by a small percentage each month, or cutting back on discretionary spending in incremental steps. Review and adjust your plan regularly. Your financial situation and priorities can change over time, so it's important to periodically review your savings plan and make adjustments as needed. Set aside time every few months to evaluate your progress and ensure that your plan is still aligned with your financial goals. Stay flexible and adaptable. Life's unpredictability means that your savings plan may need to change at any time. Stay open to adjusting your strategy as needed and be prepared to adapt to new financial challenges or opportunities that come your way. In summary, adjusting your savings plan when needed is an essential part of maintaining financial resilience and staying on track toward your financial goals. By regularly reassessing your priorities, analyzing your budget, and remaining adaptable, you can effectively navigate changes in your financial situation and continue to build a solid foundation for your future. In this video, we've discussed the essential steps to building an emergency fund from scratch. We've covered understanding your spending habits, tracking expenses, identifying areas to cut back, automating savings, setting up a dedicated account, scheduling regular transfers, maintaining financial discipline, tracking your progress, and adjusting your savings plan as needed. By following these steps, you can create a solid financial safety net for yourself and your family. We hope you found this information helpful and are inspired to start building your emergency fund today. If you enjoyed this video and learned something new, please give it a like, subscribe to our channel, and share it with someone who might benefit from this advice. Now, we'd love to hear from you. What challenges have you faced while building your emergency fund, and how did you overcome them? Share your experiences in the comments below, and let's learn from each other's successes and setbacks on the road to financial security. Thank you for watching, and remember, together, we can conquer our financial goals.